All right. Good morning, everyone. And thank you for kicking your day off here with the Lytham Partners Fall 2024 Investor Conference. My name is Robert Blum, managing partner of Lytham Partners. During this presentation, we welcome Greenfire Resources, ticker symbol of GFR on the NYSE, as well as GFR on the TSX. And joining us today from the company is Robert Loback. Robert is the company's vice president of corporate development and capital markets. Before I turn it over to Robert, I just want to remind everyone that management is available for one-on-one meetings today throughout the conference. If you've not already signed up and would like to schedule a one-on-one, please shoot me an email. That's Blum, B-L-U-M, at lythampartners.com, or visit the landing page for the conference website there. That's lythampartners.com/fall 2024. From there, you can click on the investor registration to make your one-on-one selection. So, Robert, thank you so much for your participation today during the conference, and the floor is all yours.
Thank you, Robert. Good morning, everyone, and thank you to the Lytham Partners team for organizing the conference. Looking forward to walking the group through the Greenfire story this morning, and happy to host follow-up one-on-one conversations to further get into the details of Greenfire strategy and value generation plans. Greenfire Resources is a growth-oriented oil sands producer focused on the development of our Tier 1 oil sands assets in Western Canada using steam-assisted gravity drainage, or SAGD. Greenfire's currently producing assets have production of 19,000 barrels per day and have production capacity of 34,000 barrels per day at our existing facilities that we plan to reach over the next 2 years by implementing standard SAGD production growth and optimization techniques. As Robert mentioned, we're publicly listed on the New York and the Toronto Stock Exchange under the symbol GFR, with a current market capitalization of about 700 million Canadian. Our only debt outstanding is our senior secured notes due 2028, with a current outstanding value of $239 million US. That's following our 61 million excess cash flow redemption in July of this year. These notes include an excess cash flow redemption mechanism whereby 75% of excess cash is used to repurchase the bonds and lower our debt levels. In terms of our tax pools, we have 1.8 billion of tax pools, which result in us not being cash taxable until around the end of the decade, depending on your commodity price assumptions. Similarly, we have high royalty pools that allow us to enjoy lower crown royalty rates called the pre-payout royalty rates for oil sands, which is a benefit among several of our peers, as well as no gross overriding royalties or no private royalties on our Hangstone facilities. Together, we think these three attributes allow us to have higher free cash flow generation potential relative to the majority of our oil sands peers when we're at our debottleneck capacity and in a higher commodity price environment. So let's review our currently producing SAGD assets. The company operates the demo asset with 100% working interest. Now, this facility has a capacity of 7,500 barrels per day. The company also operates the adjacent expansion asset with a 75% working interest. The other 25% is owned by the Chinese CNOOC. Now, this facility has a capacity of 35,000 barrels per day. Both these facilities share the same Tier 1 SAGD reservoir, which provides structurally lower capital and operating costs relative to most peers. Now, our assets are located right in the center of the Athabasca region in northern Alberta, Western Canada, among all the other franchise SAGD assets. Everything that Greenfire currently owns and operates was originally constructed by the Japanese state oil company JAPEX and their Canadian subsidiary Japan Canada Oil Sands. The Japanese conservatively operated their SAGD assets, which we believe provides material opportunities for value generation via production growth. The company is targeting production growth of from 19 to 34,000 barrels per day, implementing what we consider to be the SAGD playbook. And now that's drilling redevelopment infill or refill producer wells, implementing surface facility optimizations, think water and vapor handling, and executing NCG co-injection. These are all standard in SAGD. Almost every other SAGD site in Alberta implements these production optimization techniques. Now, to deliver this production growth plan, the SAGD playbook is underpinned by 183 million barrels of proved reserves with a reserve life index on a proved basis of 28 years. The NPV of these reserves is approximately 2 billion Canadian or $24 Canadian per share net of debt. For 2024, the company is targeting annual production growth of 13 to 19% relative to 2023 levels for annual production of 20 to 21,000 barrels per day. This assumes 2024 capital expenditures of 80 to 90 million, which is predominantly to be allocated towards drilling activities for drilling the company's redevelopment infill wells. When you think about the SAGD business, the cost structure is relatively fixed. As we add production volumes, we aren't contemplating adding additional transportation capacity, no additional steam generation, no material changes to staffing, which means that the majority of incremental revenues flow to the bottom line, which results in higher operational leverage to production growth and commodity pricing. Greenfire's near-term plans for production growth is going to be driven by drilling and optimizations, which provides material exposure to an improvement in Canadian heavy oil pricing. Now, Greenfire's production is 100% linked to WCS or Canadian heavy oil-based benchmarks, which provides a material exposure to improvement in heavy oil pricing. The Trans Mountain Expansion Project commenced operations in May of this year, which adds approximately 600,000 barrels a day of pipeline egress to Western Canada, including new access to international markets. Now, the Greenfire is poised to benefit from this exposure as the Canadian basin has typically been plagued by limited pipeline egress, excess pipeline egress, which has resulted in volatile WCS differentials and unfavorable pricing. Now, with this pipeline in place, it's anticipated to result in improved WCS differential pricing and include a reduction in the WCS differential volatility, which should support material incremental free cash flow generation. At a broker's estimate, Greenfire is believed to be the most exposed by far to an improvement in WCS differential pricing relative to all other SAGD, oil sands, and oil-weighted peers in Western Canada. Now, Greenfire, with this positive positioning, is still trades at a 40% valuation discount on an EV to flowing basis relative to our core SAGD peers, Athabasca and MEG. Greenfire currently trades at approximately 46,000 per flowing relative to MEG and Athabasca at about 74 and 79,000 per flowing, respectively. Now, today, I want to walk this group through Greenfire's strategy and differentiation, and that would be predominantly related to our Tier 1 SAGD reservoir, speak more about our producing facilities and pipeline infrastructure in place, our capital-efficient growth plan, and how that's going to drive incremental free cash flow generation and the company's intended use of that free cash flow generation in the near to medium term. A tier 1 SAGD reservoir has no top gas, bottom water, or lean zones. These thief zones provide an unwanted outlet for steam and reservoir pressure and require costly downhole pumps to produce production at targeted production rates, which results in higher capital and operating costs relative to a tier 1 SAGD asset. Now, Greenfire's tier 1 SAGD wells flow to surface with natural lift. We do not require downhole pumps or gas lift. Now, this is a structural cost advantage relative to most peers. We just open the valve and production flows to surface. The Greenfire team believes that the demo asset and the expansion asset are 2 of the 5 developed tier 1 SAGD assets in Alberta. When we quantify the productivity and recovery benefits of a tier 1 SAGD reservoir, we believe that the expected productivity profile of a tier 1 reservoir is higher per well because our tier 1 wells are not limited by downhole temperature limitations that you typically see with downhole pumps. This allows us to run our wells hotter and melt the bitumen faster to produce more production to surface. Similarly, since we don't have downhole pumps, we aren't subject to downhole pump replacement economics, which allows us to run our wells longer and result in higher estimated ultimate recoveries. When we quantify the structural cost advantage of a tier 1 SAGD reservoir, this results in an estimated savings of about $30 million per year, or $23 million net to Greenfire's working interest from not having to run downhole pumps, which require $1 million per pump replacement, with the average pump life expected to be about 2 years. And it also benefits from the savings of not having to run electricity and the associated costs resulting from a 100 horsepower downhole pump being run for the whole year. When we think about the capital expenditure profile for SAGD over the life of the asset, it's predominantly front-end weighted to construct the facilities and infrastructure associated with the SAGD project. The Japanese have spent over $2.5 billion to construct the expansion asset, which provides a very capable facility for Greenfire to maximize production out of, and is already producing at approximately 22,000 barrels per day on a 100% working interest basis. Now, both of the Hangstone facilities have well-delineated reservoirs in approved developments, which gives Greenfire the capability to apply standard production growth and optimization techniques to this sizable and scalable infrastructure to fill the plants to their debottleneck capacity. The expansion asset was originally constructed and commissioned by the Japanese in 2017. Since then, they've not drilled any refill wells or any infill wells since the Greenfire team took operatorship. The Greenfire team began drilling operations in the summer of 2023 and have drilled 10 extended reach refill wells at the asset, which have shown monthly average production rates of approximately 1,500 barrels a day per well. The demo asset has been in operation since 1999. Now, what stands out here is that production declines at the demo asset have been relatively low without the use of downhole pumps. So we think this provides a long-term durability example of our structural cost advantage from our SAGD, our tier 1 SAGD assets. The Japanese also didn't drill any infill or refill wells and drilled the last well pairs in 2013, which we believe provides further opportunity for the Greenfire team to appropriately capitalize the demo asset and grow production back to historical rates. In addition to drilling 3 redevelopment infill wells this year at a horizontal length of over 2,000 meters per well, the company has optimized its water disposal operations at the demo asset, has drilled a second water disposal well, which anticipates to receive regulatory approval to put into operation later this year, which we believe will provide additional water handling capability and operational flexibility to support production at higher sustained rates for an asset that is relatively older and is constrained by its current water handling capabilities. The expansion and demo assets are supported by expandable regional infrastructure that's capable of accommodating our production growth to our debottleneck capacity of 34,000 barrels per day and beyond. This includes pipeline infrastructure for both diluted bitumen and diluent. We do not require additional pipeline egress to accommodate our growth outlooks here. And we have ample access to natural gas, which is sourced via the NGTL system, and electricity via the Alberta grid. The Greenfire team in late 2023 supported the reservoir pressure of the expansion asset by expanding its NCG co-injection capabilities, by commissioning an NCG compressor, which allows the company to support high sustained rates of NCG co-injection and increase the reservoir pressure through the end of the year and into 2024, which has allowed the production to support higher sustained rates and will further support the drilling and production optimization techniques that are ongoing at the site currently. The core driver of production growth at both of the expansion and demo assets is the drilling of refill wells, which is a form of its incremental recovery well in SAGD. Traditionally, over the past decades, the industry has drilled what's called an infill well, whereby they would drill a new vertical and infill producer well to recover bitumen between a preheated wedge of heated oil between two SAGD pairs. Now, the industry has shifted to drilling what's called a refill well, whereby instead of drilling a new vertical producer, the team instead re-enters an existing SAGD producer well, abandons the horizontal, and kicks off to drill the refill producer to recover incremental preheated bitumen between two SAGD well pairs with marginal incremental capital expenditure, minimal geological risk, and accelerated recovery relative to a traditional SAGD infill producer well. And this, in addition to being quicker, it also saves the sourcing of additional wellhead, as well as the drilling of a vertical producer well into an active steam chamber. The Greenfire team recognized that the Japanese previously drilled 750-meter laterals, which were relatively conservative, and the Greenfire team, for its redevelopment infill drilling program, has recognized that it can re-enter an existing producer at a pad and drill across two adjacent pads for a 1,600-meter refill well that is able to produce at the rates of and recover bitumen at the rates of two of the previously drilled shorter wells. Now, this accelerates production growth with additional cost efficiencies anticipated with reduced future well counts. Refill wells have been standard across SAGD. The majority of our industry peers in the space are doing it with positive production results, including refill results that outperform both infills and, in some cases, the primary well pairs. The industry has improved its ability to drill refill wells and has shown consistent improvements in the annual production results over time as it gets better with well placement and drilling technology with these refill wells. As previously discussed, the Canadian heavy oil market is poised for a potential re-rating with the Trans Mountain Expansion Pipeline now online as of May of this year. This provides excess pipeline egress, which is supportive of more favorable WCS differentials, which we've started to see of late, as well as lower WCS differential volatility, particularly in the winter, which is very supportive of Greenfire's business, given we are 100% exposed to WCS-linked benchmarks. There's been also significant positive news flow, as about half of volumes from the Trans Mountain Expansion Pipeline have gone to international markets, particularly Asia, which we believe is very supportive of the Canadian heavy barrel, especially longer term, as global sour barrels continue to re-rate positively, and the Canadian heavy barrel now has an avenue to participate in that via the TMX pipeline. Here's a map briefly illustrating where this pipeline the route is and provides access to international markets. Greenfire realizes 100% of its pricing in Alberta markets at Edmonton and Hardisty, while we have no contracted transportation volumes on the Trans Mountain pipeline. We believe the Alberta markets for Canadian heavy are poised to re-rate and positively reflect this pipeline, given that excess transportation capacity on the legacy Enbridge and TC Energy systems are being realized, given the Trans Mountain pipeline is underpinned by 80% of the volumes on take-or-pay commitments, which is providing incremental capacity on the legacy systems. For a high-level sensitivity to core economic variables for Greenfire's operations, by far the most impactful variable is bitumen production, whereby Greenfire, every 1,000 barrels per day relative to the midpoint of our current production guidance of 20,500 barrels per day, realizes an incremental 23 million of adjusted funds flow. The next most impactful variable is the WCS differential, where every US dollar improvement in WCS differentials relative to our $15 a barrel base case annual average for 2024 realizes an incremental 16 million change to our adjusted funds flow. Tying it all together, Greenfire is focused on its production growth strategy that's anticipated to drive material incremental free cash flow generation, the majority of which will be used for debt repayment through the company's 75% excess cash flow sweep mechanism. Now, once the $300 million bond is paid down to $150 million US, this excess cash flow sweep mechanism will switch from 75% excess cash flow sweep and 25% shareholder returns to 75% shareholder returns and 25% excess cash flow sweep. Longer term, the company is a thermal oil producer focused on evaluating and maximizing value from underdeveloped SAGD assets. The Greenfire team will consider opportunities that compete with the expected returns from our existing Tier 1 SAGD assets if it can be structured in a transaction that's accretive to the Greenfire shareholders. Robert, I'll turn it back over to you for questions.
All right, fantastic. Yeah, looks like we got just a couple of minutes left here. I think, maybe topical here is sort of the announcement by, I think it's Waterous Energy Fund. Maybe you could expand a little bit on the details of the recent transaction that they announced.
Yeah, so Waterous Energy Fund, or WEF, they recently announced that they've entered into agreements to acquire about 43% of the issued and outstanding common shares of Greenfire for investment purposes. And this was at a price of about 10.93 per share Canadian from 3 existing shareholders. And this was in a part of a private transaction. Now, for those that don't know, Waterous Energy Fund is an established private equity firm based in Calgary with a focus on growth, consolidation, and compounding long-term intrinsic value per share in the oil sands. While the Greenfire team remains focused on our operations, we believe Waterous and their proposed acquisition of Greenfire shares is a clear vote of confidence in the company's growth strategy, ability to identify underdeveloped thermal oil assets, and talented team.
Maybe as an add-on to that, talk maybe a little bit about the shareholder rights plan that was put into place in response to the transaction.
Yeah, the Greenfire team announced the adoption of a shareholder rights plan to support the company's ability to maximize value for all Greenfire shareholders at this time. Now, the board of directors of Greenfire appointed a special committee of independent directors to oversee the ongoing strategic alternatives process and to consider the company's options to protect the interests of all shareholders and ensure that they are treated fairly, including in response to the transaction that's been proposed by WEF or that may be proposed by any other interested party. So the team's taking what we think is the right moves to maximize value in this situation, and we'll see how things evolve from this time.
Okay, that's helpful. Just sort of at the end of our time here, any closing comments before we wrap things up?
Well, it's been an exciting year to date with the company's positive results with the initial growth program, and clearly that is being reflected by the interests of other large cap private equity holders that have track records of identifying strong management teams and identifying existing E&P companies that are well situated. So we're excited to see where things evolve from this stage and look forward to meeting with additional investors today at the Lytham conference.
Fantastic. Well, look, thank you very much, Robert, for the very in-depth presentation here. Again, I know you have a busy schedule coming up. For anyone that would like to schedule a meeting and maybe hasn't had a chance to do so yet, whether it be today or even after the conference as well, reach out to me. Happy to coordinate. Again, the email is Blum, BLUM, @lythampartners.com, or again, visit the landing page for the conference website. That's lythampartners.com/fall 2024. From there, you can click on the investor registration button and make your one-on-one selection. So we have a great lineup of presentations today. Robert, thanks for getting things kicked off here this morning, and hope you enjoy the conference.
Thank you, Robert, and thank you, Lytham team. Have a great day.
Thank you.